Hey there, deep divers. Ever felt like deciphering U.S. taxes as an alien is like trying to solve a puzzle with half the pieces missing? It can be dense, incredibly confusing, and sometimes, frankly, a little overwhelming.
Oh, absolutely. It's a common feeling.
But what if we told you there are specific shortcuts, surprising insights, and clear strategies, things to make you not just well-informed, but also truly savvy when it comes to your U.S. tax declaration?
Indeed. The U.S. tax system has many, many layers, especially for those who aren't U.S. citizens. So our mission today is to take a deep dive into the official IRS publication 519, the U.S. Tax Guide for Aliens.
Right, the definitive guide.
Exactly. We'll pull out the most important nuggets, focusing specifically on, how different income types get taxed, how to properly prepare those tax declarations step by step, really, and critically, how to spot those opportunities to potentially lower your tax bill. Saving money is key.
Exactly. Think of us as your personal guides through this fascinating and, I have to say, financially impactful material. We're going to break down the complexities item by item so you can walk away feeling empowered and hopefully a little richer. So let's unpack this. Okay, let's start at the very beginning because this is where everything else hinges. Before you even think about income or deductions, you need to know. Are you a resident alien or a non-resident alien for tax purposes? This distinction is absolutely foundational.
It truly is foundational. Resident aliens are generally taxed on their worldwide income, just like U.S. citizens.
So everything everywhere.
Pretty much.
Yeah.
Non-resident aliens, on the other hand, they're typically only taxed on their U.S. source income and maybe certain foreign income if it's effectively connected with a U.S. trade or business.
Okay, that sounds like a big difference already.
Huge difference. Understanding your status is the first crucial step to optimizing your tax situation and figuring out exactly what you need to declare on your forms.
So for someone new to this, how do you figure that out? It's not just about your visa type, is it? I hear that question a lot.
No, that's a common misconception. It's not just the visa. There are two main tests the IRS uses to determine resident alien status. The first one is fairly straightforward, the green card test.
Green card test. Sounds simple enough.
It usually is. If you're a lawful permanent resident, a green card holder at any point during the calendar year, you generally meet this test. Your residency starting date is simply the first day you are present in the U.S. as a lawful permanent resident.
So if you have a green card, you're pretty much considered a resident for tax purposes.
Yeah.
Got it. But what about everyone else? That's where the second test comes in. And it sounds like it can get a bit more complex.
It does involve a bit more, yeah. The second is the substantial presence test. This one requires a bit of math, but it's crucial. You're considered a resident for tax purposes if you are physically present in the U.S. on at least 31 days during the current year, let's say 2024.
Okay, 31 days this year.
And in addition to that, a total of 183 days during a 3-year period. That includes the current year and the two immediately preceding years, so 2024, 2023, and 2022 for filing next year.
And for that 3-year calculation, it's not just a straight count, right? I remember reading that you weigh the days differently. It's not just to add them all up.
That's right. Good point. For this 3-year calculation, you count all the days you were present in the current year, 2024 in our example. But then only 1/3, like 13 of the days in the first preceding year, 2023.
Okay, only a third.
And just 1/6, 16 of the days in the second preceding year, 2022. It's essentially a weighted average, looking at your presence over 3 years, but really focusing most heavily on the current year.
Here's where it gets really interesting, though, and this can be a huge strategic insight for tax savings. Even if you're physically present in the U.S., there are certain days you don't count towards that substantial presence test. This is often overlooked, but it can make a significant difference in your status.
Absolutely. These exceptions are critical for some individuals. They can help you avoid meeting the substantial presence test and, therefore, avoid worldwide taxation. Super important for saving money.
So what kind of days don't count?
Okay, days you do not count include days commuting to work from Canada or Mexico. If you regularly commute, that means more than 75% of your work days.
Ah, for regular commuters.
Right. Also, days in the U.S. for less than 24 hours while you're just in transit between two foreign places.
Like a layover.
Exactly. Days as a crew member of a foreign vessel. And days you couldn't leave because of a medical condition that came up while you were in the U.S.
Oh, that's specific. Is there a form for that?
Yes. If the medical condition applies, you'll need to file Form 8843. That's your official statement to the IRS explaining why those days should be excluded. It's key for documentation.
Form 8843, okay.
And finally, days as an exempt individual. Now, this doesn't mean you're exempt from tax, very important distinction. It means you're exempt from counting those days for the test.
Gotcha. Who falls into that category?
This category includes foreign government-related individuals, usually under A or G visas. Also, teachers or trainees under J or Q visas, they also need that Form 8843.
8843 again. Seems important.
It is for these exceptions. Students under F, J, M, or Q visas, again, you'll file Form 8843 for this. And also professional athletes who are here temporarily just to compete in a specific charitable sports event.
Interesting. Any catches for teachers and students?
Yes, there are limitations. For teachers and students, there are limits on how many years you can actually claim this exemption. So you definitely need to check those specific rules if this applies to you. Don't just assume it lasts forever.
Right. Okay, so what if you do technically meet the substantial presence test? You've done the math, you've counted the days, but your life and your connections are really elsewhere. Can you still be treated as a non-resident? This sounds like a crucial escape hatch, a potential tax saver.
Yes, absolutely. This is another significant strategic advantage. The closer connection to a foreign country exception. Even if you meet the substantial presence test on paper, you can still be treated as a non-resident alien if you meet specific criteria.
Okay, what are those?
First, you must be present in the U.S. for less than 183 days in the current year.
Less than half the year.
Right. Second, you have to maintain a tax home in a foreign country during that year. Basically, your main place of business or employment needs to be outside the U.S.
Okay, tax home abroad.
And third, you must have a closer connection. Think family, social ties, belongings, bank accounts to that foreign country than to the U.S.
Makes sense. How do you claim that? Another form.
Yep, another form. This requires filing Form 8840, Closer Connection Exception Statement for Aliens. You file it with your income tax return.
Yeah.
And here's the critical part. You absolutely must file this form on time. If you miss the deadline, you generally cannot claim this exception. No retroactive claims, usually.
Timeliness is key. Okay, Form 8840 for the closer connection. That rule sounds almost like a secret weapon for those who accidentally trip the substantial presence test. What if you're a mix, though, like a dual status alien, where you're both a non-resident and a resident in the same year? How do you handle that in your tax declaration? That sounds complicated.
It can be, but there are options. A dual status tax year happens when you change your status mid-year, maybe moving to or from the U.S. Generally, you're taxed as a resident for part of the year and a non-resident for the other part. Different rules apply to each period.
So like 2 mini tax returns in one.
Sort of, yeah. But here's where strategic choices come in again. Choices that can offer significant tax advantages. For example, there's the option of choosing resident alien status for the whole year.
Choosing to be a resident even if you weren't for the full year. Why would you do that?
Well, if you're a dual status alien, you can choose to be treated as a U.S. resident for the entire year if you meet specific conditions, often involving your spouse if you're married.
Okay. And the benefit.
The big benefit is usually filing a joint return. Non-residents generally can't file jointly. By choosing resident status, you and your spouse, maybe one of you, has significant deductions or credits, can combine everything. Yes, you're both taxed on worldwide income for the whole year.
Ah, the worldwide income catch.
Right, but you might also get access to more deductions, credits, and potentially lower tax brackets overall compared to filing separately. It can be a huge tax saver, especially for couples.
That choice sounds incredibly powerful. Can you give us a specific scenario where that choice truly becomes a game changer for a dual status couple? Like, how does that look on the tax forms?
Absolutely. Imagine one spouse arrives mid-year and becomes a resident, while the other spouse was always a resident or citizen. If they don't make the choice, the newly arrived spouse might have limited deductions as a non-resident for part of the year, and they'd have to file separately. But if they choose resident status for the full year,
They can file jointly.
exactly. They can file Form 1040 jointly, potentially claim the standard deduction, which non-residents usually can't, maybe claim education credits, things like that. You make this choice by checking a specific box on your Form 1040 or 1040 SR and attaching a signed statement explaining you're making the choice.
Okay, so it's an explicit election on the form.
Yes. And be aware, it's generally irrevocable for that year. You can't easily change your mind later. A similar choice is also available if one spouse is a U.S. citizen or resident all year and the other is a non-resident alien all year. They can choose to treat the non-resident spouse as a resident just for tax purposes to file jointly. Again, weigh the pros and cons carefully.
Fascinating. So many strategic choices just based on your status. Okay, now that we hopefully know who we are in the IRS's eyes, let's talk about the money. What kind of income is typically subject to U.S. tax? And crucially, how do we determine its source? That seems vital for proper tax declaration, especially for non-residents trying to save on taxes.
Absolutely. The source of your income is critical, particularly for non-resident aliens, because they usually only pay U.S. tax on U.S. source income. Let's break down some common types.
Okay, first up, wages, paychecks.
Wages and personal services. Generally, compensation for services performed in the U.S. is U.S. source income. Simple enough.
But what if you work both inside and outside the U.S., like remote work or travel?
Good question. If you perform services both inside and outside the U.S., your wages not counting certain fringe benefits are sourced on a time basis.
Time basis. How do you calculate that for the declaration?
You calculate it by multiplying your total compensation by a fraction. The fraction is your U.S. workdays divided by your total workdays for that pay period. For example, say you earn $80,000 working 240 days total, but 60 of those days were spent working in the U.S.
Okay.
Then you take $80,000 times 60 divided by 240. That comes out to $20,000. That $20,000 is your U.S. source income subject to U.S. tax.
So you need good records of where you worked each day.
Definitely. Good record keeping is essential. And note, certain fringe benefits like housing or education allowances, they're sourced differently, usually based on your principal place of work.
Okay. Any tax-saving tips for wages?
Yes. Here's a strategic advantage. Income for personal services performed in the U.S. as a non-resident alien might actually be tax-exempt if it's paid by a foreign employer who isn't engaged in a U.S. trade or business, and you meet other specific conditions, like being present for less than 90 days and earning under $3,000. Check publication 519 for the details, but it can be a significant exclusion.
Wow, okay. Good to know. What about interest income? From bank accounts or bonds?
Interest income. Generally, interest from U.S. residents or domestic corporations is U.S. source. But here's the big tax saver.
The important part.
Right, a key exclusion. Many types of interest income are actually excluded from U.S. tax for non-resident aliens if they're not effectively connected with a U.S. trade or business.
Like what kind of interest?
This includes interest from U.S. bank deposits, savings and loans, credit unions, and most types of what's called portfolio interest.
What exactly does portfolio interest mean in practical terms? I hear that term a lot, but it's not always clear. Like, what should someone look for?
Good question. Think of portfolio interest primarily as interest on certain types of U.S. debt obligations like corporate bonds or government securities that are specifically designed to attract foreign investment. The key is that it generally can't be from related parties, certain banks, or contingent interest. And the debt usually needs to be in bearer form, targeted to foreign markets, or registered form where you've provided a Form W-8 to the payer.
Form W-8 again. It seems crucial for non-U.S. persons.
It is, especially for documenting your foreign status to avoid withholding on things like portfolio interest. The main takeaway for you, the listener, is that much of your passive interest income from U.S. sources could very well be tax-free if you're a non-resident. Don't just assume it's taxed.
Great tip. Okay, dividends from stocks.
Dividend income. Typically, dividends from U.S. corporations are U.S. source. Pretty straightforward. Dividends from foreign corporations are usually foreign source.
Usually. Is there an exception?
Yes, unless a significant portion of the foreign corporation's income, say 25% or more over the last 3 years, was effectively connected with a U.S. trade or business, then part of the dividend might be U.S. source.
Okay. Bit niche, maybe. Any saving strategies for dividends?
An important nuance. There is no 30% tax on U.S. source dividends received from a foreign corporation for non-resident aliens. Also, certain specific types of dividends from mutual funds, like interest-related dividends and short-term capital gain dividends, can be exempt for non-residents. But this exemption generally doesn't apply if you're present in the U.S. for 183 days or more during the year.
Details matter. What about scholarships or grants, especially relevant for students and researchers?
Scholarships, grants, prizes, and awards. Generally, the source is determined by the residence of the payer. If the payer is a U.S. entity, it's usually U.S. source.
How about saving tax on those?
Smart planning is key here. For candidates pursuing a degree, qualified scholarships are excludable from income if they are used for qualified expenses like tuition, fees, books, and required supplies.
So not for everything.
Correct. It's crucial to remember they are not excludable if used for things like room and board, travel, or optional equipment or clerical help. Those amounts are generally taxable.
What if the scholarship requires work, like being a teaching assistant?
Ah, good point. Any amounts that represent payment for services like teaching or research assistantships are taxable compensation, even if required for the scholarship. So you really need to understand how your scholarship or grant is broken down and documented on forms like the 1042-S.
Got it. Keep track of what the money is for. Okay, rents and royalties.
Rents and royalties. Pretty simple here. If it's from property located in the U.S. or from any interest in that property, like mineral rights, it's U.S. source income.
Makes sense. Selling property, like stocks or maybe even a house.
Sale of property. The rules here can get complex and vary a lot, depending on the type of property inventory, depreciable assets, intangibles, real property. For instance, gain from the sale of inventory you purchase while in the U.S. is generally U.S. source.
Okay, complex.
Yeah.
But any big savings opportunities here?
Yes. A surprising benefit. Sale of main home. This is a big one often missed by resident aliens. If you sold your main home in the U.S., you may be able to exclude up to $250,000 of the gain from your income.
Wow, $250,000 excluded, just like a U.S. citizen.
Exactly. And it's $500,000 if you're married, filing jointly. You have to meet certain ownership and residency requirements in the home, but resident aliens can qualify. Many assume this benefit doesn't apply to them and miss out on a huge tax break. Understanding this could significantly impact your real estate decisions if you're a resident alien owning property here.
That's a fantastic point. Definitely something to look into if you own a home. Last one for income. Gambling winnings?
Yeah.
Vegas trips.
Gambling winnings. Okay. Gross proceeds from U.S. gambling are generally subject to a flat 30% tax for non-residents. It's usually withheld right away.
30% flat tax. Ouch. Any exceptions? Treaties, maybe?
Yes, sometimes is exempted by a tax treaty. But there's also a funny, unexpected exemption. Non-business gambling income specifically from blackjack, baccarat, craps, roulette, or the big six-wheel is not taxed for non-resident aliens.
Wait, really? Just those specific games?
Just those specific table games, yes. Winnings from slots, poker, lotteries, horse racing, those are generally taxable at 30% unless a treaty says otherwise. It's a weird carve-out, but potentially valuable.
Good to know if you happen to like roulette. Okay, moving on. This is where we start talking about real money-saving tactics beyond just income exclusions. Deductions and credits. How can aliens use these to sharpen their savings toolkit and reduce the tax on their declaration?
Right. So for resident aliens, the rules are generally the same as for U.S. citizens. You can usually claim the standard deduction for your filing status, or you can choose to itemize deductions if that works out better for you.
Okay, residents get the standard deduction or itemize. What about non-residents? That seems to be where the rules diverge most.
Exactly. For deductions for non-resident aliens, it's more limited. You can generally only claim deductions related to income effectively connected with your U.S. trade or business.
And effectively connected income, just to quickly clarify again, that's essentially income from an active U.S. business you're running, or maybe salary from U.S. employment, correct? Not passive stuff like most interest or dividends?
Precisely. It's the income tied directly to your active business or performance of services within the U.S. So you can deduct ordinary and necessary business expenses related to that income. And you might be able to claim the Qualified Business Income Deduction, or QBI, which can be up to 20% of that qualified business income.
Okay, so deductions linked to the income.
Yeah.
Are there any deductions non-residents can take that aren't linked to U.S. business income?
Yes. There's an important exception. You can deduct certain itemized deductions even if they don't relate to your effectively connected income. These include contributions to U.S. charities. Charitable donations.
Right. And casualty or theft losses, but only if the loss occurred in a federally declared disaster area and the property was located in the U.S.
Okay. Limited but potentially useful exceptions. Now, the big one. Can non-residents take the standard deduction?
This is a crucial difference. Generally, no. Non-resident aliens cannot claim the standard deduction. This is a major point of confusion and means itemizing those few allowable deductions is often the only way to reduce taxable income, unless.
Unless. There's always an unless with taxes.
There is a specific strategic benefit. There's a special rule, thanks to the tax treaty, specifically for students and business apprentices from India who are eligible under Article 21(2) of the U.S.-India Income Tax Treaty.
Students and apprentices from India, what do they get?
They can claim the standard deduction. So for 2024 taxes, that would be $14,600 for single filers. That's a huge benefit compared to other non-resident students or trainees, provided they don't choose to itemize deductions instead.
Wow, that's a massive difference. A really specific but powerful treaty benefit. Definitely. Another powerful choice non-residents have relates to U.S. real estate income. It's the real property income choice.
What's that about?
Normally, gross rental income for a non-resident is taxed at a flat 30%. No deductions allowed against it. But you can choose to treat all income from U.S. real property, like rental income, as if it were effectively connected with a U.S. trade or business.
Why would you choose that?
Because it allows you to deduct related expenses, things like mortgage interest, property taxes, repairs, depreciation against that rental income. You end up paying tax on the net income, after expenses, at the regular graduated tax rates instead of 30% on the gross.
So if you have significant expenses, this choice could save you a lot. How do you make it?
You make this choice by attaching a specific statement to your tax return, Form 1040-NR. Once made, it usually applies to all future years unless you revoke it with IRS consent.
Another strategic election. Okay, what about claiming dependents? Can non-residents do that?
For dependents, it depends on your status and residency. Non-resident aliens who are residents of Mexico or Canada or are U.S. nationals can generally claim dependents just like U.S. citizens.
Mexico, Canada, U.S. nationals. Anyone else?
Yes, there are treaty exceptions. Residents of South Korea can claim their children who lived with them in the U.S. And those students and business apprentices from India under Article 21(2) we just mentioned, they can also claim dependents.
India and South Korea, too, through treaties. Good to know. And they need a TIN, right?
Yes, absolutely. Any dependent you claim needs a valid taxpayer identification number, either a Social Security number, SSN if they're eligible, or an individual taxpayer identification number, ITN. No TIN, no dependent-related tax benefit.
Okay, deductions are great, but for many, the real power lies in something even better. Tax credits. These directly reduce your tax bill dollar for dollar. What are some key credits aliens can leverage? These are crucial parts of your final declaration.
Credits are indeed very powerful. Let's look at a few key ones. First, the foreign tax credit. If you're a resident alien paying tax on worldwide income, or a non-resident with foreign source income that is effectively connected with a U.S. business.
So you're paying tax in two countries on the same income.
Exactly. In that situation, you may be able to claim a credit for income taxes you pay to that foreign country on that income. This is absolutely critical for avoiding double taxation. You'll typically need to file Form 1116 to calculate and claim this credit.
Form 1116 for foreign taxes. Got it. What about credits for kids?
Child tax credit and credit for other dependents. This ties back to who can claim dependents. Non-resident aliens who are U.S. nationals or residents of Canada, Mexico, South Korea for children living with them, or those students apprentices from India under Article 21(2).
The same groups who can claim dependents.
Right. They can potentially claim the child tax credit if they meet all the qualifying child rules, just like citizens. Other dependents who don't qualify for the CTC might make you eligible for the smaller $500 non-refundable credit for other dependents. Again, the dependent needs that TIN.
Okay. Education credits for tuition.
Education credits. Generally, these are not available to non-resident aliens. Big exception, though.
Let me guess.
Yeah.
Relates to choices.
You got it. They are available if you're married, and make that choice to file a joint return with a U.S. citizen or resident spouse, or if you're a dual status alien, making the choice to be treated as a resident for the entire year. So those elections we discussed earlier can unlock these credits.
See how it all connects? What about the Earned Income Credit, the EIC? That helps lower-income workers.
Earned Income Credit, EIC. Generally, if you are a non-resident alien for any part of the year, you cannot claim the EIC. It's pretty strict on that.
Okay, EIC is usually out for non-residents. Finally, what about tax that's already been paid or withheld?
Tax withheld. Critically important. You absolutely claim any federal income tax that was withheld from your income during the year as a payment against your final U.S. tax liability.
Where do you find this information for your declaration?
It'll be shown on various forms you receive, like Form W-2 for wages, Form 142S for other income paid to foreign persons like scholarships, royalties, some wages, Form 8805 for partnership withholding, and Form 8288A related to withholding on sales of U.S. real property interests.
So keep all those forms.
Definitely. You need them to accurately report the withholding on your tax return. This is how you get a refund if too much tax was withheld. Don't leave that money on the table.
Absolutely. So we've covered status, income sourcing, deductions, credits. But the real game changer for many aliens, a truly powerful tax-saving opportunity, is understanding how tax treaties can benefit them. This feels like advanced strategy.
It is, and it's a huge area for potential tax savings. The U.S. has income tax treaties with dozens of countries. If you're a resident of a treaty country, and this usually applies to non-residents, but sometimes even resident aliens can benefit, you may qualify for special treatment.
Special treatment like what?
Like complete exemptions from U.S. tax on certain types of income, or maybe reduced rates of tax, even if the income is from U.S. sources and would normally be taxed under U.S. law.
Okay, exemptions or lower rates. What kind of income benefits most from these treaties, and how would someone go about claiming that benefit in their tax declaration?
Common areas for treaty benefits include income from personal services like wages or independent contractor income. Also, remittances or allowances received by students and trainees from abroad. Scholarships and fellowship grants often have specific treaty articles, and sometimes even capital gains.
Could you give an example of a common personal service treaty benefit?
Sure, many treaties have a rule for dependent personal services, basically, being an employee. It might say your wages are exempt from U.S. tax if you're present in the U.S. for a limited period, often 183 days or less in a year or 12-month period, and your employer is a resident of the other treaty country, and your pay isn't borne by a permanent establishment your employer has in the U.S.
So short-term work for a foreign boss might be tax-free under a treaty.
Potentially, yes. Each treaty is different, so you have to check the specific wording for your country's treaty. Now, an important caveat you need to know about. Most treaties include what's called a saving clause.
Saving clause, what does that save?
It basically saves the right of the U.S. to tax its own citizens and residents as if the treaty didn't exist. So if you become a resident alien under U.S. law, like via the green card or substantial presence test, the saving clause often means you can't use most treaty benefits anymore.
Oh, so becoming a resident might mean losing treaty benefits.
Often, yes. However, there are usually specific exceptions to the saving clause listed in each treaty. These exceptions typically allow even residents to continue claiming certain benefits, often things related to pensions, Social Security, or benefits for students and trainees for a limited time. So even residents need to check the treaty exceptions.
Okay, so it's complicated. How do you actually claim a treaty benefit on your tax return? Is there a specific form?
Yes. To claim most treaty benefits that reduce your U.S. tax by overriding a rule in the Internal Revenue Code, you generally need to file Form 8833, Treaty-Based Return Position Disclosure under Section 6114 or 7701B.
Form 8833. Sounds official.
It is. You attach it to your tax return, like Form 1040-NR, sometimes 1040. It essentially tells the IRS, hey, I'm taking this position based on Article X of the treaty with country Y. There are some exceptions where you don't have to file Form 8333, like for reduced withholding rates on dividends or interest that are documented with a W-8BN, but filing it when reducing tax based on a treaty position is often the safest approach to ensure proper disclosure.
So if you want to prevent the tax from being withheld at the source on something like treaty-exempt income, rather than claiming it back later with Form 8053, how do you do that?
Good question. To prevent or reduce withholding upfront based on a treaty, you typically provide a specific form to the payer, the person or company paying you. For passive income like dividends or royalties, that's usually Form W-8BN. For income from personal services, it's often Form 8233. Exemption from withholding on compensation for independent and certain dependent personal services of a non-resident alien individual.
W-8BN for passive income, 8233 for service income.
Got it. Right. These forms certify your foreign status and your eligibility for the treaty benefit to the withholding agent. If you didn't provide one of these forms, or they withheld anyway, then yes, you'd claim the refund by filing your tax return, like Form 1040-NR, and likely attaching Form 8833 if required.
Okay. Anything else key about treaties?
Yes, timeliness is key in another way, too. Many treaty benefits, especially for students, teachers, and researchers, are limited in time. For example, a treaty might say a student is exempt for 5 years, or a teacher for 2 years. After that time limit expires, you can no longer claim that specific treaty benefit, even if you still meet the other requirements and the treaty is still active. You need to track those time limits carefully.
Track the years. And are treaties always stable?
Usually, but not always. Be aware of recent developments. For instance, the U.S. recently announced partial suspensions of certain articles in the tax treaties with Belarus and Russia. This means that starting on specific dates in 2024, the standard U.S. statutory withholding rates, often 30%, might apply to payments like dividends or interest going to residents of those countries, even if they previously qualified for lower treaty rates. Things can change.
Wow, okay, so always check the current status of your treaty. Beyond treaties, what are some other smart filing strategies for your tax declaration that can prevent headaches or unlock more benefits? Let's talk practical filing tips.
Okay, some key practical points. First, the Individual Taxpayer Identification Number, ITN. If you need to file a U.S. tax return but you're not eligible for a Social Security number, SSN, you need an ITN. Also needed if you're being claimed as a spouse or dependent eligible for a tax benefit. You apply using Form W-7.
Form W-7 for the ITN. Do they expire?
Yes. This is crucial. ITNs can expire if not used on a U.S. tax return for 3 consecutive years. For example, if an ITN wasn't used on a return for 2021, 2022, or 2023, it will expire on December 31st, 2024. You need to renew it if you need it for filing. Check the IRS website for details on renewal.
Good reminder to check ITN status.
Okay, what about filing status again?
Filing status. We touched on this. Resident aliens generally use the same filing statuses as U.S. citizens, single, married filing jointly, etc. Married non-resident aliens generally must file as married filing separately. The big exception is if they make that choice with their U.S. citizen or resident spouse, or the full-year resident choice, if dual status, to file jointly on Form 1040. All right, those powerful choices again. What if you're leaving the U.S.? Any special tax hoops?
Sometimes, yes. The sailing or departure permit. If you're an alien leaving the U.S. permanently or even for an extended period, you might need to get a sailing permit or departure permit from the IRS before you leave. This basically certifies that you've paid all your U.S. income tax obligations up to that point.
How do you get that? Sounds like a hassle.
You usually file either Form 1040C, U.S. Departing Alien Income Tax Return, or Form 2063, U.S. Departing Alien Income Tax Statement. Form 2063 is simply if you had no taxable income. But good news, there are many categories of aliens who are not required to get a sailing permit. This includes diplomats, employees of international organizations, many students and exchange visitors if they only had exempt income or allowable deductions, and residents of Canada or Mexico who commute frequently. So check if you're exempt before worrying about it.
Okay, check exemptions first. Good tip.
Yeah.
Any other clever strategies?
Yes, the protective return. This is a smart move if you're a non-resident alien and you're not sure if income you have should be considered effectively connected with a U.S. trade or business, or maybe you don't think you have any U.S. source income at all but want to be safe.
What does it protect?
It protects your right to claim deductions and credits if it's later determined that you did have effectively connected income and should have filed a regular return. If you don't file any return and the IRS later says you owe tax on effectively connected income, you generally lose the right to claim any deductions or credits against that income. Filing a timely protective form 1040-NR, even with zeros or just stating it's protective, preserves those rights. It's insurance, basically.
That sounds like a really smart defensive move in uncertain situations. What if you already filed but made a mistake?
Amended returns. If you find an error or omission after filing your return, you can file an amended return using Form 1040X, Amended U.S. Individual Income Tax Return. What's helpful now is that you can actually file Form 1040X electronically for recent years, 2019, and later for Forms 1040-1040-SSR, and 2021, and later for Forms 1040-NR. That makes correcting things much easier than it used to be.
E-filing amendments. That's progress. Finally, the scary part. Penalties.
Yes, penalties. Best to avoid them. The IRS imposes penalties for various things. Failure to file on time can be 5% of the unpaid tax per month, up to 25%. Failure to pay on time, 0.5% per month, up to 25%. Accuracy-related penalties if you understate your tax substantially or negligently, often 20%, but can be higher, like 40% for undisclosed foreign financial assets. And even penalties for failure to supply a correct TIN, $50 per failure, generally.
Yikes. The takeaway.
File accurately and on time. It's crucial to avoid potentially significant extra costs. Pay attention to deadlines, use the right forms, and disclose treaty positions properly.
Wow, that was a lot to take in. Seriously. From figuring out if you're a resident or a non-resident, which is huge, to strategically sourcing your income, understanding what counts and what doesn't, and then unlocking all those deductions and, especially, those treaty benefits. It's clear this isn't just about filling out a form correctly for your declaration.
Not at all.
It's really about making smart, informed decisions throughout the year that can directly impact your financial well-being.
Yeah.
How you structure things matters.
Indeed. The U.S. tax landscape for aliens, it's dynamic, it's nuanced. Knowing these rules, understanding the tests like substantial presence, and especially leveraging the available exclusions, those specific deductions non-residents can take, and treaty benefits, it can make a substantial difference to your bottom line.
It's really about being proactive, isn't it?
Exactly. Proactive, and ensuring you're only paying what you truly owe, not leaving money on the table through missed deductions or credits, but also not underpaying and risking penalties.
So what does this all mean for you, the listener? It means you have the power, really, to navigate this system much more confidently. Whether it's carefully applying that substantial presence test calculation, understanding which types of, say, interest income are truly exempt, or knowing you need Form 88833 or Form 8233 to unlock those valuable treaty benefits for your tax declaration, you're now armed with much more specific knowledge.
And remember, the IRS website, irs.gov, is a vast authoritative resource. It has all the forms, the publications like 519 we discussed, instructions, and even direct filing options for some people. Don't be afraid to use it. For specific questions, their interactive tax assistant tool online can be helpful, and there are taxpayer assistance centers for in-person help, though appointments are usually needed.
What stands out to you from today's deep dive? As you're listening, what's maybe one thing you're going to double-check or explore further about your own tax situation based on what we covered? Maybe it's that closer connection exception or the sale of main home exclusion or digging into your country's tax treaty.
Yeah, maybe think about those specific forms, 8843, 8840, 8833, W8ENN, 8233. Do any apply to you? Could they save you money?
The world of taxes might seem daunting, but hopefully with the right information broken down like this, it becomes more like a puzzle you can actually solve. Keep diving deep, explore those IRS resources, and we'll catch you on the next deep dive.